high taxes, high crime, not a very friendly business environment. Why would anyone buy and invest in Minnesota? And, I grew up here. This is where I invest in the Twin Cities metro area. And the whole Twin Cities region, the whole state of Minnesota has really, really changed dramatically since I grew up. Um, we used to be like this place of we had the largest Fortune 500 concentration companies in the twins were based here in the Twin Cities. We had Honeywell, General Mills, Pillsbury, the Cargills, let's see, Best Buy, Target. I mean, all the scientific companies as well. It's just medical device companies. We've always been just a hub of great jobs and great employment in high education. But something's happened, and our education is some of the worst in the country now. We spend the most for it. We have some of the highest taxes in the country now. And so then I'm asking myself, I've got all my investments set up in the Twin Cities area here because it was all based on that great lifestyle of the great jobs and just a great place to live. But it's really changed, and it really breaks my heart. So I have to reanalyze what I'm doing, and why would I invest here, kind of thing. So what I've done is I've kind of buried myself into AI and research and set some things up. So I've created a report that's going to be auto-generated once a quarter. I've already done the first quarter, and the second quarter report just came out. And what that's going to do is I learned this back from the National Association of Home Builders when we were trying to determine what to build and where to build and, what price point to hit at. And you have to look at the macroeconomics, right? What's the trend nationwide, the leading market indicators. And then you kind of have to go into, let's look at like this market, the Twin Cities. So let's look at the labor and job market. What's that like? Is there, because people need jobs to buy housing and to live. When the jobs left Detroit, you saw what happened to that housing market. So we have to look at the labor market and job mix, the jobs and housing balance, in income and price bands. So jobs and housing correlate with one another, and there's a ratio that a lot of the city planners will use, and like National Association of Home Builders will use, and even the Realtor Association will use that metric to try to determine what a comfortable balance is between the jobs and housing units. And then the regional, exurban, are going to look at the growing rings of the Twin Cities as well. So we got to look at the national, Minnesota, Twin Cities, and the local market, including the core suburbs. And then let's look at what it means for investors like me, builders, and like policymakers. So this report can be found, and it's free. You go to craigcammon.com/market-report.com, or just go to craigcammon.com. It's right up on the top bar. And you can go ahead and view this report. But I'm going to run through this real quick online here. So let's figure out how to share the screen here. I got a monitor up above me. So we'll go. Okay, so now you got this. So this is the report. It's craigcammon.com/market report. Just click on that. You might have to enter your email address to get access to it, but it's free. So this is what the contents, what we're going to look at. I kind of ran through that. So national macro environment and leading indicators. So as of second quarter 2026, we're going to look at kind of the macro for the U.S. So GDP growth is 2.2%, moderate expansion, slowing. CPI inflation 3.5%. That kind of plays into the mortgage rates. We're targeting 2%, or the Fed wants to target 2%, so that's why they may want to raise rates. So it's down from 4.2% in May, but it's above the 2% target. Unemployment rate nationally is 4.2%, down from 4.3%. So low unemployment rate. 30-year mortgage rate is 6.55%. Now, historically, that's a really good rate. However, our home prices and incomes didn't keep up with home prices, because home prices shot up because of the ultra low rates, which is an abnormal once in a lifetime we see those rates that low. So Freddie Mac weekly survey. Let's see, what does this mean? Index of 100%. So conference board, national payrolls 57,000. Okay, so reading the indicators, conference boards ticked up 2026, driven by a rebound in equity prices and an uptick in multifamily building permits. But the 6-month trend remains slightly negative, consistent with slow growth environment rather than strong expansion or recession. Okay. National Housing Production Context, National Association of Home Builders showed housing market index averaged 35 over April, down from 37 Q1. So builder sentiment is low. Macro implications for the Twin Cities, the national environment of elevated rates, moderate growth, and stubborn inflation is a direct constraint on Twin Cities housing production and affordability. Material cost pressures from tariff on lumber, steel, and another 8 to 12% of new construction costs compared to the 2020 baseline. Compressing builder margins, limiting supply of new and entry-level homes. Okay, so this is AI generated. My opinion, it doesn't address the building permits, the zoning, the building codes, and what we're required to put into houses. So with that being said, we'll just keep going on. So Minnesota economy overall. So the state GDP is $472 billion. And all these sources are cited in here. So if you want to double check things, state unemployment rate is 4.4%. It's down slightly from 4.5%. Statewide payrolls, 3.69 million. Median household income is 82,000. The 2023 community survey estimate, the census, ninth highest nationally for labor force participation rate is 68.2%. Minnesota Department of Economic Development, above national average. There's 15 Fortune 500 headquarters here in the Twin Cities, and there's a couple that would be considered Fortune 500s that would rank in that top 15 if they weren't privately owned and they were publicly traded. So we have United Health Group, Target, stable, diverse base. Minnesota's economy is moderately performing. The statewide unemployment rate, such a stretch, blah, blah, blah. Payroll employment at 3,068,900, up 1.5% year over year. So we added 13,200 jobs May and June. So now we get to the Twin Cities, non-farm payroll, 1.987 million. Wage growth, 1.4%. Average weekly wage, 1528. CPI in the metro area is 0.7%. Okay, this gets a little interesting. So the job mix by wage tier. High wage private. So these are the corporate headquarters, finance, professional, technical, manufacturing, financial activities, professional and business services, information, manufacturing. Estimated employment, 662,400. That's a third of the share of the jobs. Now, we went down 3% in financial. They lost 4,400 jobs in the high wage. Professional and business lost 3,400 jobs, 1.2% down. Information lost 700 jobs, down 2.5%. Manufacturing up 1,600, so almost 1%. So the high wage private payroll is contracting. That's not a good sign for the housing market. Mid-wage essential. So this is going to be your education, health services, government, mining, logging, construction. So that's 725,200 estimated employment. So that's 36% of the share of the jobs. So education and health, it grew by 3.7%, 13,700. Government increased 8,900. That grew almost 4% to 3.7%. Construction modestly gained 1,200 jobs, 1.2%. So this area is growing. This is mid-wage essential. Okay, but let's look at this. Government and education and health, these all require taxpayer funding. right? Now, health is probably going to be largely due to our aging population, is my guess. But this is kind of a net drag on the economy because it takes tax dollars to support this job, and we're losing tax dollars on the high wage private. So the lower wage services, that's going to be your retail, hospitality, food service, trade, transportation, utilities, leisure, hospitality. 618,000, 619,000, 31%. So transportation, trade, utilities up 1,000. Let's see, leisure and hospitality up 600, other services down 2,600. Okay, so it's roughly flat. So we have government and healthcare growing exponentially, and we're losing jobs on the high wage, and we're remaining flat on the low wage. And this is source of BLS, published July 2025. Okay. The most notable structure shift is the mid-wage essential sector, particularly healthcare and government, are now the primary engine of job growth in the metro, while high-wage private sectors, finance, professional service, information are collectively contracting. This bifurcation has implications for housing demand. Mid-wage job creation tends to generate strongest demand in the 280 to 420 for sale range and the 1,400 to 2,200 month rental range. While high wage sector softness is reducing pressure at the premium end, if the high wage sector construction is cyclical, demand will return. Cyclical demand will return, reflect structural change, remote work, offshoring, AI-driven efficiency. All of the above, I believe, are true. The demand recovery will be slower. And so basically, excuse me, what we have here is a failure to communicate. Name that movie. Anyhow, so the structure of our jobs are changing in the Twin Cities. We're going to the more of the mid-wage essential, government and healthcare. And then what we have always prided ourselves here on, the big corporate Fortune 500 companies, professional services is contracting by a substantial amount, 3%. So you run that for several years. There's a lot of factors into it, like a lot of these companies relocated. Cargill's one, they relocated a bunch of jobs out of state. Minnesota passed this law where you have to do medical paid leave. So you can take up to, I forget what it is. It's like 3 or 4 months off for medical leave for any reason you want, basically. And that fund is already bankrupt. So that's putting extra costs on employers. So they're relocating those jobs out of state. So it's not just that AI is taking those jobs. It's just not cost effective to do them in state anymore. So they, where money's not treated well, it leaves. So we're losing that. And keep in mind that I love this Twin Cities area. I invest here. I sell real estate here. I don't want to see it like this, but I have to understand where my investment's going. That's why I'm doing this. So let's look at supply and demand in the housing units. We're going to get back to what this means. We had the housing demand, mid-wage job creation, a demand for the 280 to 420 for sale range, and 1,400 to the 2,200 a month range. Okay, so this is structurally impossible to build inventory there, and there's a limited supply. I mean, you can't add more supply, but we're going to outpace this rent. So housing is going to get freaking expensive in the Twin Cities because we can't build where it's needed. So anyhow, housing units, there's 1,390,000 housing units estimated for 2025. That's the 7-county region. That's a Met Council estimate. 10,000 a year lagging need permits. So we're only at about 4,376 permits year to date. 13 county metro area. That's the greater metro area. 11% year over year from Keystone reports. Single families up 3%. Multifamilies up 52%. Okay. I'm sorry. It looks like it's down 3%. So we're struggling with the single family inventory. They can provide multifamily pretty easy. Like you get one apartment building might supply 100, 200 units or 50 to 200 units. Single family, it's hard to produce 50 to 200 units. You need a lot of land to generate that. So the single family is getting harder and harder to produce, especially at that lower price point. And then there's structural reasons for that. I'll get into that later. So the multifamily permits were 1,515 multifamily units, not units, but properties. 13 counties, up 52%. Okay, so here's the permit trend 5-year contract. We'll just kind of jump into it. 2021, 22,600 permits. Single family was 12,000 units, 10,600 multifamily units. We hit the goal, right? They want the 18,000. So we went over the 18,000 goal. 18,000 is what Met Council estimates we need for housing units added every year. So in 2021, the Twin Cities hit that. The 13 county region hit that. 2022, we missed it by 2,000 units. That's when the rate shock hit. Okay, 2023, we missed it by 2,400 units. 2024, we missed it by 5,661 units. That's multifamily collapses, single family gains. Okay, so these are in the pipeline. 2025, third consecutive miss. 2026 year to date, running below goal. Okay, so what we have is a multi-year run, several years of missing our housing unit projection to keep the supply demand relatively close. So we're creating a supply imbalance because of the cost of construction with the high interest rates. We have other issues that I'm not addressing right now. One of them is going to be the Met Council providing water and sewer on what land you can develop within the Twin Cities area. You can't just develop any land. It has to be within this MUSA line where you can get the utility services. So that limits the amount of land that's developable, which drives prices through the roof. So, we needed housing in that 200 to 400,000 price range, I think it was, that we talked about earlier. Land prices start at 350,000, and you haven't even put in any utilities yet, let alone constructed a house. So we can build at $1 million here, but we can't provide anything in that price range that people need housing in. To do that, we have to go way outside the Twin Cities to get outside of that perimeter to tap utilities. Okay. So the metro-wide median price record 410,000 in June 2026, according to Minnesota Realtors. It's up 2% year over year. New listings are increasing. Okay. So this is what we're looking at. We're looking at the actual housing units, the demand. We're not looking at the market units and the market demand. Those are two different animals. So the market units is going to be the number of people that put their home up for sale, and the demand is the number of people looking to make a move that particular year or that particular moment. And that has a lot to do with basically mortgage rates and whatever crisis is going on in the economy. So that's very much cyclical economy driven. We're talking structural housing units that are built, that are being built, permitted, and jobs that exist and what they pay. So we're looking at, in spite of no matter what's going on in the economy, housing units to demand. So that's really what we're trying to understand here. The price to income ratio using the metro median home of 410,000 against the metro median household income is 87,000 to 9.6 to 4.7 above the traditional 3 to 4 times threshold for affordability. So we're already unaffordable based on that three times threshold. And that's usually what mortgage lenders would like to see. That's going to be your front end ratios. So what mortgage rates at 6.5 right now, almost 6.6. The monthly median priced home has increased approximately $200 a month. Okay, good seeing you back. It's been a while. I've been deep diving into this stuff, so I'm going to try to catch up here. So homes affordable at 80% AMI. Minneapolis Fed's 2025 analysis documented a 61% decline since 2021 in home affordability. Approximately 99 to 105,000 for a family of 4. Okay, the 3-year cumulative shortfall versus the 18,000 unit goal, a rental vacancy of 5.4% below the healthy 6 to 8% range, and the median price to income ratio of 4.5 times collectively indicate a housing market under structural supply pressure. The modest improvement of the January 2026 permit run rate is a positive early signal, but 1 month of data does not indicate a trend reversal. Okay, so let's look at the jobs to housing balance and income price bands. Okay, so there's a ratio, and this isn't a science, but this is kind of a NAHB uses this, like different community planners will use this metric, and it's going to say we need a healthy range of housing units to jobs would be between 1 and 1.5. And right now we're sitting at 0.7. So I'll kind of explain this a little bit. So we have 960,000 approximate housing units in 2000 and about 1.5 non-farm payrolls. That's 0.62 units job ratio. Pre-recession expansion, strong job growth. Okay. So the target for a healthy market would be that between 1 and 1.5%. Now, if you go back into history, I don't know if we've hit that maybe in the 80s. And that's where, it's just the house prices aren't shooting up. There's enough housing for people to buy it at a reasonable price. You're not in bidding wars, that kind of thing. So we have increased. We got to the 2010s. This was after the foreclosure wave. We got to 0.81. We almost hit 8%. Post-recession, jobs fell faster than housing. Okay, when we lost all the jobs, we almost got to that healthy balance. So we're structurally short of housing units, is what this is telling us. And then right now we're back to 0.7, that current period. So we're still short of housing units is what this is telling us. And this metric is based off of jobs. This is just kind of a big macro picture. So in all the figures are census, ACS, FRED, employment, and Metropolitan Council estimates. Affordability-based tiers, affordability bands. The HUD area median income for Minneapolis-St. Paul Metro is $131,500 for a family of 4. Okay, so this is going to tell us what price ranges in demand. So if you're looking at max affordable purchase price, we said our home prices were $400. You have to be 120% of the median income. And we have relatively adequate. Most new construction in this range market is better served. So once you're over that 400 or over that 390,000, you can start building product. When you're under this, you cannot add housing inventory. You're going to have to subsidize it to make it work. So we're running into a real housing crisis coming into the Twin Cities. So we're going to kind of look at where to invest is where this is ultimately going to go. So more and more people are falling into these brackets and need to invest unless incomes skyrocket, which I don't see happening. Local market panels, core suburbs. Let's see, Plymouth, medium single family home price, 480 to 545, townhouses 320 to 370. So a 1-bedroom apartment's 1,400, 2-bedroom apartment is 1,800, 3 to 4 is 2,150. Number of permits, estimated approximate month supply, 2.5 to 3.5 months. So these are the suburbs, and then I will expand this if you guys want to look at more suburbs. This is just the markets that I look at. This is where I'm investing. So these are kind of the products I'm looking at buying and renting, and this is what I currently hold in these areas and some others. And then notable observations, Edina remains premium outlier with median single-family home prices nearly double the metro median. Minnetonka, Plymouth are the most attractive high suburbs markets with deep inventory and strong competition at that 450 to 550 price range, driven by move-up buyers and existing equity. So you can look at more of the detailed areas and then the regional ex-urban. So what we have in the Twin Cities is we limited the water and sewer. I talked about it at Met Council, the MUSA line, where you can't develop land unless you have access to the local water and sewer system. So what they've done is they've choked off the amount of developable land. I'll try to create the picture like this. And rather than keep expanding that bubble, they hold it tight, which drives the land prices up, which forces higher density housing. So what's happened is small towns outside of the area then expand their water and sewer. So we're leapfrogging our growth into these ex-urban areas. So we go way out to tap off their water and sewer to get house prices down. So those are the areas that are starting to grow: Wright County, Carver County, Sherburne, Scott. And then you go to the East Metro, North and South. That's all growing ex-urban, leapfrogging as well. I will expand this to include more of the ex-urban. I'm just kind of starting this report right now, trying to grasp it and understand it. So this also wraps it up for a summary for investors, builders, and policymakers. So the supply is constrained at the 50 to 100% AMI. Roughly, households earning 66 to 130,000 annually, which corresponds to the 155, 320 for sale range, and 1,600 to 3,300. Like I said, you can't buy a lot in those suburbs for under 350. So that's just the land. So it's hard to build anything cheaper than the land cost. This income tier represents a large share of the metro's workforce and is finding few options in new construction, which has largely been concentrated above 400,000, and that's because we artificially throw that land price through the roof. So then the ex-urban communities are showing active development, and even at that, even when they get the land prices down, they're still struggling to get under the 500, but you can still do it. But it still exceeds the affordability ceiling for many people. Obviously, the core city markets, Minneapolis, first ring suburbs, those areas are hard to provide that housing. And then the job mix implications, we talked about that, the mid-wage essential employment, healthcare, and government, and away from the high-wage private sector employment, finance, and professional services driven implications for the housing demand profile. If this shift is durable, demand growth will tilt toward the 280 to 420 for sale range in the 14 to 2200 rental range. I think that's a given. I mean, I don't see any changes unless the government changes in Minnesota. But right now it's a one-party rule, and we're getting higher taxes, we're getting more regulations, we're getting higher crime, and we're getting the private Fortune 500 companies relocating jobs out of state because of the cost of doing business here. So this trend, there's no sign of this trend going to be reversing. So if you're going to invest, we know that there's, I'm going to call it artificial demand being driven up by poor policy choices in this price range. So you can buy here and you're going to gain equity because the shortage of housing and the job growth in those segments is going to force prices up because there's more and more competition competing for a limited supply of inventory, and the rent prices are going to go up too. So from that perspective, this is a great area to invest. As tragic as that sounds, that's not a healthy market, but it's what we have here. Now, where we run the risk is if they overreach and do too much regulation on investors and landlords. So that would be the risk on investing here. So Scenarios: if permit production accelerates towards 16,000 to 18,000 units a year, the supply pressure will gradually ease, rent growth moderate, entry-level affordability improves incrementally over 3 to 5 years. Most likely requires both multifamily recovery and continued single-family activity in the ex-urban ring. If permit production remains near 12 to 13,000 a year current trajectory, structural supply gap widens further. Rents rise faster than incomes. Home ownership rates for first-time home buyers decline. Cost-burdened households share increase. The Minneapolis Fed's trending toward a less affordable future characterization becomes increasingly accurate. If mortgage rates decline meaningfully towards 5.5%, transaction volume will increase, pent-up demand is released, new construction becomes more financially feasible for both developers and buyers. Risk: rapid demand release without supply acceleration could push prices up faster, temporarily reducing affordability before supply catches up. If the high-wage private sector downturn deepens, recession scenario, job losses, concentration in higher income households, demand for premium products softens, workforce income demand remains more stable due to healthcare government stability, permit activity slows, blah, blah, blah. Okay. So you have a built-in factor here that it's sad, but you're betting on bad policies are going to make you money. That's what investing in the Twin Cities really has become. So if you're going to own something in that mid-range affordability bracket, you can go in, you can buy, and you can take that housing unit from what would be a homeowner, and you can rent it out. That demand for that housing is going to continue to increase because they can't add any more supply to it. And the government's not going to change its policies where that higher tier is going to keep moving up, so we can keep adding higher tier, and then that whole supply chain moves down. See if I explain that right. So when you build a new apartment building, that's like Class A, that is premium, the top of the line dollar rent. And as that apartment building or that house ages, it's no longer a premium. That's no longer Class A. That moves into like Class B, Class C. So that rent starts to move down. And pretty soon that stuff that's 20 years old is more in that mid-range level because we keep adding supply, the newer stuff, the nicer stuff. So we keep that going up, but we're losing that now. So now we're just going to be competing for what's remaining here because we're losing that demand on the higher end. So we're not going to be adding as much supply there. So that's going to create pressure on housing units, but you can bet against it. It's like shorting the dollar, right? You know they're going to keep printing dollars. So you're going to short it. You're going to buy real estate. Here you can buy real estate and have the government choke off supply and choke off incomes. So that just creates more competition for the inventory you buy. It's kind of like you just rig the market in your benefit. Now, the risk you're going to have is pretty soon people will be outraged, and then the government will bite back and say, well, you can't rent it for X amount. We're going to do rent caps. We're going to do rent control. St. Paul has tried that, but they blew up in their face, and they're not really actively enforcing that like they used to. Minneapolis was going to do it, and they haven't proceeded with it. So there are problems with investing in a state like this, but on the same time, they've also rigged the market to you can't lose when you bet against them. So that's my take on it. If you want, you can read this report. Sources are cited here. It's going to come out every quarter. If you go up to craighammond.com and then just click on market report, you may have to enter your email address. So that's what I got. So you guys got any questions? Let's see. Mansipal, good seeing you back, Craig. Good to see you. I'll move this down so I don't have to hurt my neck. I get a monitor right above me here. Job numbers, just numbers to compare. New builds in Oklahoma in 2025 averaged $254,000 for a single family. Median household income was $66,000. 15.5 thousand new permits, net job loss of 21,700. What are you losing jobs to in Oklahoma? I thought Oklahoma was doing well. Builds mainly in metros, Oklahoma City and Tulsa, median towns, 25 to 60,000 population. Small towns, sub 15,000 is stagnant. Okay. Wow, land is cheap. 25,000 to 80,000 for suburban or exurban raw lots. That's buildable lots. That's fantastic. We're going to pay what we call a sack and whack fee of 30 to 40,000 just to connect to the water and sewer on these lots. So you're going to buy the lot for 300 to 400, and then you got to pay another 30 to 40,000 for a sack and whack sewer access, water access fee. And then you're going to have to pay your building permits, which is going to be another probably 40 to 50,000. And then at the same time, they scream for affordable housing. So they are the arsonist and the firefighter. So I'm still not sure what I'm going to do. Like, do I continue to invest in this market? I mean, we know the game is rigged. We know that housing prices are going to skyrocket because they're not going to allow us to add inventory. They're going to make it illegal to build anything affordable. And they're going to chase out the good paying jobs because they don't care. So what do? You play the game a little bit, and then, buy some of this, take advantage of the current situation, and then start moving some eggs out of this basket. I think that's probably the wise move, because the bet is safe right now until they go after the landlords, because they're going to blame the landlords for their failed policies. So that's the strategy I think I'm going to go with. That's where I've been just burying deep into reanalyzing what I'm doing. I've been diving into AI, looking at my investments, looking at other markets, trying to see where to invest, where's a friendly state to invest into. There are benefits to still investing here. We still have 15 Fortune 500 companies. We have a lot of other companies that are pretty close to that level, that are privately traded. So there is still a good job market here, but it's changing. It is changing, and there's no doubt about it. It's not a complete shit show yet, but it's heading that direction. So I think there's still time to make money here, but I do want to diversify a little bit. So if you guys got any opinions on where I should be looking to invest, let me know. If you guys need help in investing in this market, let me know. That's all I got today. So I'm going to sign off, and I'll check back on probably this weekend. I'm going to try to jump on here. So look forward to seeing you this weekend. Have a good one.